Hello, I'm David Cassidy with the market update today, Wednesday, the 12th of August. Now, this morning's headlines have been concentrated on the UK's Q2 GDP data, covering April, May and June, obviously, which showed the UK economy contracted by 20.4%. Now, although this shouldn't have come as a surprise, as we could all see that the coronavirus lockdowns closed most of the economy, there have been plenty of negative headlines, especially comparing our 20.4% contraction to that of, say, Germany, which contracted by 10.1%, France contracted by minus 13.8%, Italy minus 12.4%, and Spain minus 18.5%. So while we can't dispute the UK's weak relative Q2 performance, these are not simple apples to apples comparisons. Italy and Spain were both impacted by the coronavirus much earlier than the UK, meaning that their Q1 GDP, January, February, March, contraction was much bigger than the UK's. Additionally, the UK had a relatively long lockdown. For example, while Germany went into lockdown at roughly the same time as the UK, they started easing their restrictions nearly a month before the UK. Also, as the consumer accounts for around 60% of the UK economy compared to just over 50% in Germany, the closing of shops and restaurants had a much bigger economic impact in the UK than in Germany. Also, there are plenty of positives to draw from today's data. For example, the economy appears to be recovering quicker than even we expected, and we've been among the most positive commentators as the UK economy expanded by 8.7% in June. Additionally, May's growth was revised up to 2.4% from 1.8%, and April's contraction was revised to 20% from 20.3%. And equity markets have this morning given their seal of approval to these positives, with the FTSE 100 index currently trading up around 1.5%. In addition, given pubs and restaurants reopened in July, and judging by the success of the government's Eat Out to Help Out scheme so far in August, we expect GDP data for July and August will look very good. However, despite this positivity, we still believe that the UK needs further monetary stimulus, and as such that the Bank of England will cut UK interest rates or increase quantitative easing, or maybe both, as health, employment and Brexit concerns are likely to keep a lid on consumer spending. For example, as the government's job retention, otherwise known as the furlough scheme, is now starting to be wound down and ends completely on the 31st of October, unemployment is likely to rise sharply in the coming months.